Well, we had some new information that just came in mere moments ago. Yes, it's our weekly ethanol production update, and here are the numbers. If you have a pen handy and want to write them down, here we go. Last week, we held pretty steady, actually, on the nation's ethanol production. What it worked out to be was 1.004 million barrels per day. That compares to the previous week when we had 1.005. Well, pretty close. They were only down by 1,000 barrels a day across the entire nation. So just like a drop in the bucket there in difference. The 4-week average notched upward just a little bit, 1.015 million barrels per day. That would be 2,000 barrels a day higher than what the average was a week ago. The only fly in the ointment here was the ethanol stocks number picked up significantly. It is up to 24.4 million barrels this past week, and that would be 700,000 barrels higher than what we had a week ago. On the plus side, we had the imports remaining at zero this past week as well. What are the markets doing right now? Let's go to the corn, soybeans, and wheat, and then we'll go to Chicago and find out what the talk is on the trading floor. Corn has turned lower. We have May corn down 1.25 pennies at $3.70 per bushel. It is off of its earlier low by about 1 penny now. We have December 1.5 pennies lower at $3.93 3/4. Meanwhile, in the soybean market, soybeans have just kind of been all over the place here today. The May, the May overnight was higher. And then after the open, we went lower, got down below $9, hit $8.99 1/4, and now it's back up to $9.03. So it's still down, but only 1 penny now. And we have November new crop soybeans down 1/2 at $9.37 3/4. Same thing. They've been on both sides of unchanged here. On the wheat market in Chicago, we have the May now 3.5 higher again at $4.60. There for a while, it was down. We have July 2 3/4 higher. Kansas City wheat on the May contract is now 3 3/4 higher at $4.39.5, and July up 2.5. There for a while, they had been a couple of pennies lower. What about Minneapolis wheat? Well, we have the May contract 2 higher now at $5.67 1/4. Same story here. July 2.5 higher at $5.65 3/4. Let's go to the trading floor and find out what the discussion is among the traders out there where the markets are happening in Chicago. So at the edge of the CME group, we have Scott Gecas of Walsh Trading. He joins us now. Scott, boy, a lot of variations here in the markets, kind of gyrating around higher and lower on the grains. Why?
Yeah, I mean, it's going back and forth one way or the other. Right now it's just price discovery. Are they going to push them lower? Are they going to bring them higher? The one thing that is definitely driving is the headline talks. We had a little bit of a negative headline yesterday. You've seen a little bit of sell-off. Then the news later came out today that there's going to be meetings for the next 2 weeks. So we got to wait and see what is actually going to come out of that. Well, with the large short interest in pretty much all the grains across the board, you're very subject to short covering. That short covering could happen at any given moment in time. Now, the fear of that short covering is definitely confirmed with the skew in the upside calls. In soybeans alone, you're paying about $1 more for the upside calls. In corn, it's almost $2 more than for the calls versus the puts. So that leads me to believe that we know that the short covering is going to come. We just don't know when.
Okay, we'll come back in a moment, and I want to get your thoughts on that sort of strategy on the livestock side, too. We're talking with Scott Gecas, and we'll be back after a very short break. Come on back. Scott Gecas is at the edge of the trading floor in Chicago, and we rejoin our conversation with Scott right now. He's with Walsh Trading. As we look at the livestock trade, let's go ahead and dive into our futures. And on the April live cattle, we are higher across the board, but boy, not by much. We're higher by 22 cents at 129.35. We have June live cattle 13 higher at 122.85. And on the feeder cattle market, we go ahead and start with the April contract, which is down 38 cents right now at 147.43. But all the deferreds, if you go from May on out, they're all fairly sharply higher. We have May now up 88 at 151.40. It's already at a premium to the April. We have August up 90 for the biggest gain. It's at 156.47. And if you look at our lean hog market today, on the lean hogs, we have the nearby April up $1.58. There they go again. 72.40 is the last trade. One tick off of the high of the day. May now up $1.42 at 80.58. And we go back to Scott Gecas. Scott, this lean hog market seems like it has really found the route that it wants to take, and there's no holding it back.
Yeah, I mean, it's very clear that it's a definite uptrend. It's just a matter of how long is this uptrend going to sustain. With the hopes that this Chinese import campaign is going to happen, if that does happen, I mean, we could see very significant higher prices. Right now we're targeting that 75 level as the first target, but it's got lots of room to run to the upside. It's all due to the African swine fever. Reports today that it hit the 20th province in Vietnam. Clearly not contained, clearly not being, it's definitely a big factor. When this all started, China came out and said, well, if it affects 10% of their herd, then it's equivalent to all of U.S. pork that was exported in 2018. So right now, the numbers are projected 20 to 22%. So if that happens, you're going to see a very significant jump in hog prices.
Okay, on the beef side, things are kind of flat here on the fat cattle market. What is holding it back at this point?
Well, the cattle market is really odd. So it's very clearly in an uptrend. You have strong cash. Production in the second quarter was higher than expected. The demand is still there. Now, for the last few weeks or so, I've been talking about that 130 line, the open interest building and building. Going into the week, the open interest was around 7,500 contracts of open interest. Today, coming in, it's 4,500 of open interest. So people are definitely scaling back on that 130 line, but the 132 and 133s are starting to build as well.
With the volatility in the livestock, what is that doing to the options premiums there? Are they affordable?
Yeah, same thing. It doesn't matter if you're looking at cattle or hogs. The premium is definitely elevated and higher to the call side rather than to the put side, to the downside. So
have you had customers that are doing some sort of option spreads these days, maybe buying and selling, or what?
Yes, that's a great way to do it, is using spreads, taking advantage of that higher volatility, sell that volatility, buy something against it for protection, and just wait for those volatility levels to collapse.
I know you talk about that a lot, and thanks for bringing that to the table. I always look forward to our talks. Appreciate it. Scott Gecas, he's with Walsh Trading in Chicago, and that is one thing that they really focus on is options strategies for farmers.
Very much so. Thank you guys very much.